Hi, Assalamualaikum and a very good day to everyone. My name is Nurul Ashikin binti Muhammad Isa, the first presenter for today, and these are the list name of our group members. So, today we will explain and present the financial position and the performance of the company that we have chosen. Okay, we have choose these four companies in telco industries, which are Maxis Berhad, Axiata Group Berhad, Digi.com Berhad, and lastly Time.com Berhad. Now, I will explain a little bit information about the company that we have chosen. Firstly, Maxis Berhad is a communication service provider in Malaysia and the headquarters is located in Kuala Lumpur. They provide a variety of communication product, application and value-added services for consumers, large enterprise and small or medium business owner. Second, Axiata Group Berhad, commonly known as Axiata, is a Malaysian multinational communication conglomerate with extensive operation in Asia. It is the one of the largest wireless carriers in the country. Third, Digi.com Berhad is a mobile provider in Malaysia. Its largest shareholder is Telenor ASA of Norway with 49%. On 24 May 1995, Digi became the first telco in Malaysia to launch and operate a fully digital cellular network. And lastly, Time.com, listed on the Stock Exchange of Malaysia since 2001, is a fixed-line telecommunication provider that connects businesses and homes by harnessing the talent of the capable, most people, and the largest available technologies. Okay, now we move to the next slide, which is liquidity ratio. What is liquidity ratio? Liquidity ratio is important class of financial metrics used to determine a debtor's ability to pay off current debt obligation without raising external capital. It measures liquidity or availability of the firm's liquid resource. It determines whether the company can pay current maturing liabilities on time. In liquidity ratio, it consists of current ratio and quick ratio. This is current ratio of the four company. Current ratio is measure of short-term solvency and indicate the extent to which the claim of short-term creditors are covered by current asset. From the chart above, we can see that Time.com Berhad is the highest among all the four companies, which is the company's ability to pay short-term obligation on time from 2017 to 2019, followed by Digi.com Berhad, but still below the industry average. For the Maxis Berhad and Axiata Group Berhad, it shows that the company is the lowest in the current ratio and it's below among the industry average. Next is quick ratio. Quick ratio is also known as the acid test ratio. It's a type of liquidity ratio which measures the ability of a company to use its near cash or quick assets to extinguish or retire its current liabilities immediately. From the chart above, we can see that Time.com Berhad is the highest among the four companies and above the industry average. This shows that the Time.com Berhad ability to pay its short-term obligations without relying on inventories, followed by Digi and Axiata Group Berhad. It shows that the quick ratio of the company is unstable and it decreasing every year. For the Maxis Berhad, is the lowest quick ratio among the four companies. It shows that the company cannot pay its short-term obligations. As I presented my part, I will pass next topic to my next presenter, which is Nick. Nick, you may proceed.
Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is Nick Faizura binti Tua Zakara and I'm from Group 2A. Thank you, Ikin, for the introduction and liquidity ratio presentation. I will continue from here to present on leverage ratio and activity ratio. What is leverage ratio? Leverage ratios are used to determine the relative level of debt load that a business has incurred. The purpose of leverage ratios is to measure the firm's financial structure to the extent to which the firm is levered by debt, the ability to service its debt, and the degree of financial risk inherent in the financial structure. The higher degree of indebtedness will result in higher risk as it indicates that the firm is subject to higher fixed payment obligation. Higher risks are associated with higher return. With proper use of debt of leverage, the firm will be able to get more profit as the cost of debt is cheaper, interest is tax deductible, and the firm finances its activities with less equity, and any profit will be appropriated among relatively few stockholders. This will result in higher earnings per share. In short, leverage ratios are used for a portion of the analysis when determining whether to lend money, but a great deal of additional information is needed before a lending decision can be made. There are three types of leverage ratios, which is debt ratio, debt to equity ratio, and times interest earned. However, in this presentation, we will only cover two ratios, which are debt ratio and times interest earned. Debt ratio. Debt ratio is defined as the ratio of total debt to total asset expressed as a decimal or percentage. It can be interpreted as the proportion of companies' assets that are financed by debt. The debt ratio indicates the amount of debt in the financial structure. The higher ratio reflects the higher amount of debt to finance asset. The formula of debt ratio is total debt divided by total asset. A debt ratio greater than 100% shows that a company has more debt than asset. However, based on this chart, debt ratio for all companies show less than 100%, which indicates that the companies have more assets than debt. Obviously, based on the report, DG shows the highest debt ratio in 3 consecutive years within all 4 telco companies. Times interest earned. Times interest earned, or TIE, measures a company's ability to pay the interest charges applied on the debt used. It represents the margin by which the company's EBIT can decline before the company has trouble in meeting its interest obligations. The formula of the company's TIE is earnings before interest and taxes EBIT divided by interest. Based on the report of 4 companies, it shows that Time has the most TIE for the last 3 years compared to other companies, followed by DG and then Maxis and Axiata respectively. The reason why Times get higher TIE ratio because their earnings before interest and taxes EBIT has been increased at the same time interest expense has been decreased, so that Times receive a higher times interest earned ratio than other 3 companies. The higher ratio indicates that the firm can meet loan charges and lower risk of default because earnings are significantly greater than annual interest obligations. However, a high ratio can also mean that a company has an undesirably low level of leverage or pay down too much debt with earnings that could be used for other investment opportunities to get higher rate of return. Activity ratios. Activity ratios are financial metrics that use to gauge how efficient a company's operations are. The term can include several ratios that can apply to how efficiently a company is employing its capital or assets. Activity ratios indicates how efficient the manager uses the available resources in order to generate sales and its contribution towards the achievement of the firm's goal, whether to maximize the shareholders' wealth. These ratios look at the manager's effectiveness in managing the firm's asset and efficiency in handling the firm's operation. There are 5 types of activity ratios, which are average collection period, accounts receivable turnover, inventory turnover, fixed asset turnover, and total asset turnover. For this presentation, we will highlight on average collection period and fixed asset turnover. Average collection period. Average collection period is the amount of time it takes for a business to receive payments owed by its client. Companies calculate the average collection period to make sure they have enough cash on hand to meet their financial obligations. It used to appraise the company's account receivable that relates to the company's credit policy, which is credit standards, credit terms, and collection policy. The average collection period is calculated by dividing the accounts receivable by daily sales. Average collection periods are most important for companies that rely heavily on receivables for their cash flows. Average collection period represent the average number of days between the date of credit is made and the date of purchases pays for the sale. A company's average collection periods is indicative of the effectiveness of its account receivable management practices. Businesses must be able to manage their average collection period in order to ensure they operate smoothly. Based on the report of Time, DG, and Axiata, the trending shows that their average collection period ratio are higher from 2017 to 2018, however, lower from 2018 to 2019. Low average collection period shows in 2019, and it shows that the organizations collect payments faster in 2019. Nevertheless, for Maxis, the trending shows that their average collection period ratio are higher from 2017 to 2019. It shows that the company has higher ratio in 3 consecutive years, and this means the company has problem in collecting debts. Maxis average collection period shows longer. It would need to adopt more aggressive collection policy to shorten that time frame. I will hand over to my friend Ashraf to continue further on the other ratios. Thank you.
Thank you, Nik Kaizura. Assalamualaikum and hi everyone. My name is Muhammad Ashraf bin Abdul Rahim. Today, I would like to continue to explain about activity ratio for Maxis, Time.com, Axiata, and Digi, which is fixed asset turnover. And under profitability ratio are operating profit margin and return on equity. What is fixed asset turnover? Fixed asset turnover measures the firm efficiency in using its plant and machinery to generate goods or product for sale. A higher fixed asset turnover ratio implies that management is using its fixed asset more effectively. The difference between the fixed asset turnover ratio and the asset turnover ratio is the asset turnover ratio uses total assets instead of focusing only on fixed asset as done in the fixed asset turnover ratio. To find fixed asset turnover, we divide sales with fixed asset. As we can see in the bar chart, in year 2017, Time.com showed the highest ratio among all, starting at 1.64 times and followed by DG and Maxis at 1.61 and 0.57 times. The lowest is Axiata at 0.40 times. However, in year 2018 and 2019, Time.com fixed asset turnover ratio continued to decrease to 0.66 and 0.43 times, and DG maintained to be the highest among all at 1.59 and 100 times above the industry average. This shows DG is efficient in using its fixed asset to generate goods or product for sale.
Now, let's move to profitability ratio. What is profitability ratio? Profitability ratio measures the relative success of the firm. That is, the combined effect of liquidity, activity, and leverage management on the firm overall operating results. Higher ratio is preferred as it tends to satisfy and meet the expectation of all parties involved on the firm operation that include management team, employees, creditors, and stockholders. This will promote the achievement of wealth maximization, firm ability to attract outside capital, and the firm ability to sustain growth. There are 6 types of profitability ratio. First is gross profit margin. Second, operating profit margin. Third, operating ratio. Fourth, net profit margin. Fifth is the return on equity. And lastly is return on asset. But for today, we will highlight only on operating profit margin and return on equity. Operating profit margin is a measure of the operating profit, EBIT or earning before interest and tax, relative to sales. It relates the firm's ability to control all costs except interest and taxes in its operation. Higher ratio is preferred as it indicates a lower cost structure and will result in higher profits. To find OPM, we divide EBIT with sales. As we can see on the bar chart, DG shows its ability to control all costs except interest and taxes in its operation by being the highest value for 3 years in a row among 4 companies at 31.31%, 31.86%, and 30.05% respectively. However, for Maxis, starting 2017-2019, its OPM continued to decrease from 30.56 to 25.77% and to 1.86% respectively. Even though Axiata OPM is increased in year 2018-2019 from 11.13% to 17.59%, its ability to control all costs except interest and taxes in its operation is below the industry average for each year. For my opinion, Axiata can try to negotiate better price with its suppliers to reducing its cost of goods sold so it can get better improvement on its operating profit margin. Lastly, we go on return on equity. What is return on equity? Return on equity or ROE measures the return earned on the common stockholder investment in the firm. The higher the return, the better are for the owners. As we can see on the bar chart, DG showed the highest return on equity over 3 years. It's exceptionally big ROE compared with its other company, which seem to be lower than industry average. Even though ROE for DG has been decreased every year from 2017 to 2019 at 284.68%, 228.88%, and 217.12% respectively, DG still generates an outstanding return to shareholder compared with industry average. It is largely because of its high dividend payout and capital return that keep the shareholder equity low. In year 2018, you can see Axiata is affected by the strengthening of the ringgit Malaysia and record losses from idea investment and one-off asset write-off due to modernization and technical obsolescence, which result in lower translate result at negative 30.02% than in year 2019. It bounced back at 11.22% behind Maxis and Time.com at 21.49% and 11.35% respectively. Okay, that's all from me. I will pass to my friend Nisa to continue on the market ratio. Thank you.
Thank you, Ashraf, for your presentation. And now it's my turn. Hi, Assalamualaikum. I'm Khairunisa binti Zakaria from class NBFO2A. I will continue to present on the next ratio that is called market ratio. The market ratios are important for investors and management as well, as these ratios are used to decide whether the valuation of the shares are overvalued, undervalued, or at par with the market. They tend to reflect, on a relative basis, the common stockholders' assessment of all aspects of the firm's past and expected future performance. These ratios are used for making investment decisions in stocks of companies. Here we consider two popular market ratios that we want to analyze. The ratios are dividend payout ratio and price to earning ratio. The dividend payout ratio provides an indication of how much money a company is returning to shareholders versus how much it is keeping on hand to reinvest in growth, pay off debt, or add to cash reserves, also known as retained earnings. The dividend payout ratio can be calculated as the yearly dividend per share divided by the earnings per share, or equivalently, the dividends divided by the net income, or you can calculate by using earnings per share and dividend per share value as shown in the slide. Several considerations go into interpreting the dividend payout ratio. Most importantly, the company's level of maturity. From the bar chart, we can see in 2017, Maxis payout ratio is reasonable, thus dividends payment are covered by earnings. Time.com also has low payout ratio with the dividends payment are well covered by earnings. However, Axiata and DG have high payout ratio, therefore dividends payment are not well covered by earnings. In 2018, Maxis and DG payout ratio is high and that's not good. As you can see in the chart, Axiata has negative 18.06 payout ratio value. That means the company generates a net loss and still pays a dividend. A negative payout ratio of any size is typically a bad sign. It means the company had to use existing cash or raise additional money to pay the dividend. For 2019, two companies with low payout ratio are Time and Axiata. It also shows that Axiata has a tremendously increased from its loss in 2018. However, Maxis and DG dividends payment are not well covered by earnings. Now, let's move to another ratio in market ratio, that is price to earning ratio. The price to earning ratio or PE ratio is the ratio for valuing a company that measures its current share price relative to its per share earnings. The PE ratio measures the amount that investors are willing to pay for each ringgit of firm's earning. The level of the PE ratio indicates the degree confidence that investors have in the firm's future performance. A high PE ratio could mean that a company's stock is overvalued, or else that investors are expecting high growth rates in the future. In 2017, from the bar chart, all companies except for Axiata are relatively has good value of PE ratio. Meanwhile, Axiata is poor valued based on its PE ratio. It shows that investors might not confident in buying the Axiata shares compared to the other three companies. While in 2018, Axiata has negative PE ratio with the value of 7.55. A negative PE ratio means the company has negative earnings or is losing money. Investors buying stock in a company with a negative PE should be aware that they are buying shares of an unprofitable company and be mindful of the associated risks. Other companies have slightly high value of PE ratio compared to average industry ratio. Now let us see pie chart of 2019. Roughly, we can see that all companies have similarities in the values of PE ratio except for Times that is slightly lower. And we can see again for Axiata the significant increase on its PE ratio as Axiata is recovered from its loss last year. Now we have come to the end of the presentation. From the trend and combined analysis, we can conclude the performance of the company as below. Firstly, we will see on the liquidity ratio. Time.com has higher liquidity ratio for both in current ratio and quick ratio. It means that the firm's liquidity seems to be good. Secondly, the leverage ratio. Once again, Time.com is in higher amount of debt to finance assets and it also can meet loan charges and lower risk of default. Next, we look into activity ratio. Axiata is more efficient in collecting debt, while Time.com is having difficulties in collecting debt. However, Time.com and DG efficiency used fixed asset to generate sales compared to Maxis. For profitability ratio, we can see that Time.com and DG has better productivity such as in operating. DG also has higher return value to shareholder. And last but not least, we will look into market ratio. Time.com has low payout ratio and dividends payment are covered by earnings. Investors might have confidence in all the companies except for Axiata in 2018 as the company faced a loss. All companies averagely doing good as in current situation, telecommunication provider is considered as essential services in Malaysia. And that's all for now. We hope that we have given you some knowledge on the financial ratio analysis. Thank you.